private lender IndusInd Bank posted a healthy set of numbers yesterday, largely solid, in line with expectations. Let's quickly take you through those. Well, the net interest income came in at 4,867 crore versus the 4,850 crore, which was the consensus that we had built in. And therefore largely in line set with regard to the NII. The NIMs, which is the net interest margins, expanded by just about 1 basis point on a sequential basis, but it's a tough quarter, right? You are seeing margins getting eroded for most banks, and IndusInd Bank margins not eroding largely because it has a larger fixed book and holding up very, very well. So that's a positive coming through. In fact, the other income number came in fact slightly better than expectations, and even though the OPEX was elevated, therefore you saw operating profit come in, grow around 12% or thereabouts, come in at 3830 crore. We had built in a consensus estimate of around 3850 crore, so largely in line with estimates. Let's look at provisioning, because that's the key here in terms of credit costs and provisioning. Well, IndusInd Bank provided for 992 crore of loan loss provisions in this quarter, and the expectation was 1,000 crore odd number. So largely better than expected where the provisioning number is concerned. Profit after tax therefore coming again largely in line, 1% higher than expectations. So absolutely in line, 21-24 crore is where that PAT number came in at, a 1.9% ROA. Again, good and impressive. You're seeing NPA ratios decline, but decline very, very marginally. 1.94 is where the GNPA is at. 0.58% is where the NNPA is at. Just 1% decline, 0.01% decline in that NNPA number. In terms of growth, very healthy on both sides of the balance sheet. 21% growth on the advances front, 15% growth on the deposits front. That was largely disclosed anyway, so nothing new coming in there. Let's also talk about management commentary. Well, the management spoke about good loan growth. They spoke about cost of deposits peaking in Q2 of FY24. So you will start to see a possible margin expansion thereafter. Of course, need to wait and watch in Q2 how that plays out. ECL, they believe that the impact of that is going to be 1 to 1.5% of books. So that's one big piece that still needs to move. But IndusInd believes that they have enough buffers available to be able to absorb that 1 to 1.5%. They've also launched their digital platform. The affluent deposit growth is quite strong. On the deposit growth, they believe that they're continuing to gain market share, especially in the non-resident segment. The higher OPEX, they say, is largely due to the 12,600 employee additions, and they are expecting cost to income to start to come off. 46% was the cost to income. They are expecting it to come in at 45% in FY24 and decline to 41 to 43% in FY25. But listen in to what the lender had to say.
We don't need capital. We are very well capitalized as of now. Do you think a bank which has 18.40 as capital adequacy ratio will need capital? Why would you need a capital? Well, accruals are enough and will continue to add to the capital. So please understand, our utilizations, our risk-weighted assets have gone down. So your utilization of capital has gone down as a consequence. If you see last quarter, we were at 17.6. We are already at 18.4 because of the risk-weighted assets going down. And we balance our portfolio in such a way that our risk-weighted assets of the portfolio continue to show a decline.
All right, and let me also take you through what the brokerages are saying on IndusInd Bank's results and where they're expecting the stock price to head. Let's start with Kotak then, and Kotak has maintained a buy on the stock and they've hiked the target price to 1,600 rupees from the earlier 1,350. They're saying that this is another quarter where lower provisions have driven earnings. They're seeing lesser volatility and more predictability in the business environment for the bank, and they're saying that the re-rating potential is capped from a relative perspective. Moving on, let's also see what JP Morgan said, and JP Morgan has maintained a neutral on the stock. They've hiked the target from 1,060 rupees to 1,250 rupees, and they say that credit cost beat is driven by contingent drawdown. They say that NIMs have come in flat and deposit rates are expected to peak in the second quarter. Moving on, we also have Goldman Sachs. They have maintained a buy on the stock. They've hiked their target from 1,586 to 1,681. They say the Q1 is in line and numbers have good quality to them. And they say that the strong play on commercial retail will see an uptick going ahead. They remain constructive on the stock as well. And lastly, we've also got Morgan Stanley. Then it's releasing their views on IndusInd Bank. They have maintained an overweight on the stock. They've hiked their target from 1725 to 1800 per share. They say that Q1 had steady margins and Q1 saw easing credit costs and improving liquidity and growth as well. They see good returns via compounding and re-rating, and they say that the rate cycle has peaked. So all of these brokerages coming out with different views, but the common consensus here is all of them have hiked their targets for IndusInd Bank going forward.